All right, we're looking at slight gains here in futures after we closed 69.50 last night. 30 minutes to go until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, earnings season enters its busiest stretch as global stocks march back towards fresh record highs.
Goldman CEO shares some of his predictions for the year ahead, outlining key tailwinds and risks for the economy in a Bloomberg exclusive.
And tariff talk. President Trump threatens to hike duties on South Korean goods, but markets are unfazed.
I have one market that is certainly phased this morning, Matt, and that is the health insurance stocks getting slammed. Let me show you.
Not for tariff reasons, though, right?
Nothing is getting slammed for tariff reasons. That's like, did it even happen?
Yeah.
I'm not sure it did. This happened, though. So you had announced plans to keep payments for private Medicare flat next year. Just to put this in perspective, analysts were expecting as much as a 6% jump. That on top of that, UnitedHealth forecasts its first annual revenue drop in more than 3 decades. So we're down as much as 17.2% for Humana, Matt.
Yeah, and they've already been beaten down. General Motors expects profit to grow as much as $2 billion this year, from $13 to $15 billion on adjusted earnings before interest and taxes. It plans to give back a lot more money to shareholders through a higher dividend as well as stock buybacks, and that stock is near an all-time high, $82.50. I spoke with the CEO, Mary Barra, after the company's report, and we talked about how GM is navigating the current tariff environment.
If you look at our portfolio, I think, for the most part, we've worked to offset it, and with efficiencies across the board, making smart decisions on where we produce. And so very little has gone to the consumer because we are such a cost-sensitive business, and it's such a competitive business. But we continue to look at all of those levers, and we stay focused on consumer affordability.
That was just part of my interview with the CEO and chair of General Motors, Mary Barra. Joining us now to discuss is Bloomberg's Detroit bureau chief, David Welch. And David covers the company very closely, has written the book on Mary and General Motors. So, David, what do you think of the results and more importantly, I guess, the forecast, right? Everything looks pretty rosy for General Motors.
The forecast does. You got a low-end profit growth of $300 million, high end of $2 billion. And that's in an environment where most analysts are predicting a slight dip in U.S. sales, which is where GM makes most of its money. And you've still got tariffs out there that are costing GM some cash as well. But, hey, they're selling a lot of vehicles. They grew market share last year. The vehicles they're selling are very expensive and very profitable. And they're going to sell fewer EVs since they lose money on those. Every one that they don't sell doesn't hit the bottom line. So there are a lot of things that are at GM's back at the moment. For the quarter, it was actually pretty rough because of the write-downs for the electric vehicle business. But on an operating basis, the company continues to make a lot of money.
Do we know, it seems like GM is doing a little bit better than Ford in terms of the write-down, just the sheer size, right? $7 billion and change for General Motors, almost $20 billion for Ford in 2025 alone. And GM has a much larger product portfolio of EVs. Why does it look like it's not doing as badly?
I think Ford was spending a lot of money to tool up some future EVs, and they've pulled back on that stuff. So there are probably some supplier commitments there that they have to deal with. The 2 EVs that they had on the market, or still have in the market, the F-150 Lightning and the Mustang Mach-E, these are vehicles that, they had a battery pack that they were buying. They didn't have a lot of commonality, or really any commonality with other vehicles in the lineup, so they were very expensive to make. So I think all of these things you add up, and it was an expensive vehicle program for them. In GM's case, they had one platform that you could just, for the battery, that you could just make in different sizes, and a couple of battery plants. They hadn't built the 4th one yet in Indiana, so there were things that they had planned but didn't do yet. So you add these things together, and I think Ford just had an expensive program that they then had to write down. GM's, look, $7.6 billion is nothing to sneeze at. That's a lot of money they've had to write down, and there could be more to come, but the worst appears to be behind them. from write-downs.
David, thank you very much for this. And by the way, recommend David's book called Charging Ahead, perfect for this moment, about GM Mary Barra and the reinvention of an American icon. David Welch, thank you very much. Another set of earnings we had this morning, American Airlines. They missed estimates for the fourth quarter, but it did give a bullish outlook for the year. Bloomberg Chief Global Aviation Correspondent Sid Phillip joins us now. Sid, I watched the stock market reaction when these earnings came out. It plunges and then it rebounds. There's already a little bit of mixed messages coming from a lot of the big operators so far to start the year. What message did you get from American?
So American is sort of they're looking to cash in on the same trend that has propelled United and Delta Airlines. They're sort of focusing on premium, they're focusing on upgrading their cabins, they're also focusing on adding Wi-Fi to the planes, and they think that will bring in the big spenders. At the same time, American Airlines has struggled with both the government shutdown as well as the most recent Storm Fern in New York and the US this week. And with more bad weather on the way, we still don't know what the impact of the weather will be. I mean, they talked about how just the last storm alone forced them to cancel about 9,000 flights, and I estimate it'll cost them about $150 to $200 million. So there is a lot of uncertainty at the moment, especially with weather. There's also uncertainty about demand, but the airline's hoping that pivoting to premium and focusing on those premium customers will continue to sort of help them go forward.
We look at often the 5-year picture for any stock, just because in the comp function that is a default, and I think it's a decent window to compare. American has done far worse than United, and even worse than Delta. So what's wrong with this airline? Is it that it doesn't deal well with storms? Is it that they haven't been cashing in previously on the premium passenger? Or why haven't they been doing as well as their competitors?
So Americans got a multitude of things that they sort of worked on, including the fact that they did sort of focus on premium and on business travelers primarily. And post-pandemic, business travel demand was slower to recover than the premium leisure travel trend that both Delta and United sort of focused on. In terms of the storm and the impact of the storm, American has a large domestic operation, and they have a lot of operations to regional airports, and those were harder hit, especially as some of those airports weren't really equipped to deal with such bad weather, and so therefore the effect was more pronounced.
Sid, what's going on with JetBlue? This was supposed to be an airline that was righting the ship. Wrong metaphor for a plane, I realize. But they were supposed to be investing more into their premium travel. What went wrong? I mean, 5% loss in the pre-market after earnings. That's pretty painful.
Yeah, I mean, JetBlue is sort of still trying to pivot and still trying to sort of figure out what their business model is. I mean, the airline has sort of tried to go after the premium travel, especially as ultra low-cost carriers faced customer sort of hesitation in terms of bookings. I mean, remember, every CEO has been talking about this K-shaped economy and this K-shaped booking curve where people at the top end of the market tend to be booking holidays while people at the bottom end are holding off. And so JetBlue has tried to sort of turn the corner around and try to sort of focus on those customers, on the higher end customers. But at the same time, the airline is struggling in terms of being able to cash in on actually that demand.
All right, Sid, thanks very much. Bloomberg Sid Phillip covers aviation for us on the news side. Later this hour, we're going to discuss American's earnings with TD Cowen's Tom Fitzgerald as well. So more on American and the airlines. Now, well, more right now on the plane makers. Boeing generated cash for a second straight quarter and reported a 57% bump in sales to close out 2025. Its backlog has surged to a record $682 billion. Bloomberg's Brooke Sutherland covers industrials and joins us now. So that's a massive order book, $682 billion of planes. How quickly can they turn these out, and what are the headwinds that they face?
Sure. I mean, I think you saw some real progress in this past period in terms of being able to ramp up production of both the 737 and working toward that ramp up of the 787. I mean, if you remember where we were just a year ago, that would have been very hard to imagine for Boeing. And so this is, hard-won progress that they've made in terms of ramping up their output. And that will help them, continue to chip away at that backlog and really see that surge of deliveries that's so key to getting that cash flow that investors are really looking to see from Boeing after a few very rough years for the company. And, what's really driving that backlog, we've seen, a number of airlines step up their purchases as a way of sort of currying favor with the Trump administration. And so that's certainly been a boom to Boeing, seeing that sort of aircraft diplomacy in these trade wars. And so I think, they're in a better position to capitalize on that demand that they're seeing than they have been for a while now.
Speaking of industry affected by the administration, well, I guess it's every industry, but specifically defense, Brooke. We've been getting their earnings coming in, Northrop and RTX both reporting. How are these companies handling the pressure coming from the Trump administration, whether it's being called out about munitions, questions being raised and threatening of reducing shareholder returns, cash returns, and CEO pay? How are they handling all that?
Well, I don't think it is a coincidence that RTX this morning highlighted the 20% increase in munitions output that it's achieved and the $10 billion that it spent in both company and customer-funded CapEx last year. And, the portion I was able to listen to of the earnings call before I joined you all, they spent a decent chunk of time in their prepared remarks talking about all of those capital expenditures and all of the different states in which they are making investments. And I think that was very deliberate. If you remember, just a few weeks ago, President Trump specifically called out RTX as being, one of the defense contractors that the Pentagon is having trouble with in terms of its goal of ramping up output and sort of limiting shareholder returns. Now, I do think that these CEOs are sort of trying to walk a line of, being supportive of the administration's goals, and certainly they would like to see this, increased defense spending that the president has been calling for, while also being cognizant of the fact that it's not exactly clear how the president would go about imposing these regulations that he wants to see on company buybacks or dividends or executive pay. It's not clear what the mechanism would be to enforce that, or even what the mechanism would be to decide, what companies would be subject to those restrictions. And so I think there's a lot of question marks there. I think most CEOs probably feel pretty confident about their ability to keep doing, sort of having control over their share buybacks. But inevitably, we're going to see a period of increased capital expenditures. And I think the question for investors is sort of what that looks like down the road, because when you step up your investments, that is not going to be as robust for your cash flow. And is that something that investors are comfortable with? Is that a good trade-off for them ultimately? And I think we're going to see a lot of questions about that in this earnings season.
Brooke, this has been so excellent. Thank you for breaking those down for us. That's Bloomberg's Brooke Sutherland. Some more earnings this morning. UnitedHealth forecast a decline in 2026 revenue, its first annual drop in over 30 years. Its peers, though, are also falling this morning sharply after the U.S. government proposed holding payments to private Medicare plans flat next year. Bloomberg's Ike Swetlitz covers the sector and joins us now. Ike, the expectations were as high as a 6% bump in payouts. How did we get this so wrong?
So the Trump administration was expected to be, pretty friendly to Medicare Advantage, these private Medicare plans. The president's been under more pressure to address the affordability of health care for Americans, and we're seeing something different than folks expected.
So these shares, a lot of them have already taken a massive hit, Ike, and I guess investors were buying the dip to some extent, hoping that they could recover. Does this mean that's off?
Well, the projections that United put out for next year, are also, I think, a big part of what's going on. As you said, seeing declining revenue coming in the future for the first time in a long time.
All right, Ike, thanks very much. Ike Swetlitz there talking to us about the healthcare companies, which we will continue to follow and show you, taking big 10 and 20% drops, a number of different stocks in healthcare. Coming up, my interview with GM CEO Mary Barra, which is going the other way. The share's up 5% in the pre-market. The company discussing its strategy of selling a lot more of the high-margin ICE cars and trucks and fewer of the money-losing EVs. Regulatory shifts really helping this company in this market. This is Bloomberg Open Interest. Let's get out of high interest. Look what's making headlines around the world. President Trump's Border Patrol Commander Greg Bovino is leaving Minneapolis following mounting public outcry over the killing of 2 U.S. citizens by federal agents in recent weeks. The White House is sending border czar Tom Homan to ease tensions, meet city leaders, and refocus enforcement on undocumented immigrants with criminal records. Homan will meet with Minneapolis Mayor Jacob Frey to discuss coordination between federal and local law enforcement to accomplish that task. Goldman Sachs CEO David Solomon says the firm expects a slower pace of hiring this year as the bank looks for targeted growth. He joined Bloomberg from the firm's annual conference in Hong Kong.
It's probably a little bit more constrained in 26 because we see opportunities for efficiency and we're trying to deploy those. But ultimately, we've also said those efficiency opportunities give us more of an opportunity to invest in parts of our business where we can scale growth. And some of that growth scales with additional headcount. I point to our wealth management business, which scales with people all over the world.
General Motors expects profits to rise by up to $2 billion additional this year, driven by strong demand for its highest margin trucks and SUVs. The automaker forecasted adjusted earnings before interest and taxes of up to $15 billion and announced a $6 billion share buyback, plus raising its dividend. GM says a more favorable U.S. regulatory environment is supporting its outlook, even as it scales back on electric vehicle expectations. And I spoke with the CEO and chair, Mary Barra, following the company's results. One of the topics we discussed was the shifting regulatory environment and the landscape for electric vehicles in the U.S.
The whole industry, we were on a path that we were working to get to 40 to 50% EVs by 2030. So now that the regulatory environment has changed and the consumer incentives have gone, there is going to be slower EV adoption. We're still committed to EVs, and we've got a great portfolio that we're working on taking costs out of. But in the meantime, we also have a great internal combustion engine platform. And you're right, full-size trucks are one of the strengths we have, as well as full-size SUVs, mid-size crossovers. So we really have a strong lineup across the board, and that is really what is, fueling our business success.
I have had, as the host of Hot Pursuit, a Bloomberg podcast about cars, the opportunity to drive a lot of your EVs, from the Sierra EV to the Hummer EV to the Escalade IQ, and they're fantastic products. Are you not deterred that Americans aren't buying more of these vehicles? You know how capable they are. You know how useful they are in daily life. What needs to happen for more Americans to buy these EVs?
Well, I think the consumer is very rational when they're making a decision about what car to buy. Let's remember, it's one of the most important and expensive decisions that they make. And one of the things we have to continue to work on to drive EV adoption is a more robust charging infrastructure. And that still is continuing to happen. So every quarter, more and more chargers are available. I think as people in their individual communities see that they've got a robust charging network and believe if they have to go on a road trip, there's that as well, they're going to make that choice. And what we do see is once someone buys an EV, they see the technology, they see the driving experience, never having to go to the gas station, and they stick with EVs. So I think it will happen over time, and that's why during this period we've already got a great portfolio of EVs. We're going to continue to take cost out to get our EV portfolio profitable, and we're going to be well positioned as EV demand grows over the next handful of years.
What about the hybrids, Mary? I mean, GM was really a front runner, not only in EV technology, but in hybrid technology with the Chevy Volt. I remember when the Tahoe came out with a 6-liter gas engine and electric battery power. Will you start to sell more of the hybrid vehicles?
Well, we have always focused. As you said, we have great hybrid technology. We have great EV technology. We're one of the few OEMs that invested in a dedicated EV platform that allows us to have the portfolio we have. So we're focused on the end game, and we have affordable EVs. So I think that's where our primary focus is. We understand the technology. We have it in other regions. You'll see us with a handful of hybrids as we move forward. But right now, our focus is really on having the right internal combustion engine portfolio and the right EV portfolio moving forward. And I think we're demonstrating that that's a winning formula, because over the last 4 years, we've gained share each year.
And the shares have gained as well. I mean, not just today, but they're near a record high right now, trading at about $84 a piece. It's interesting. She's talking about hybrids sitting in front of that Corvette ZR1X. It is a 1,250 horsepower hypercar. I mean, twin turbocharged 5.5-liter V8 with the electric powertrain. I think it is the fastest production car or the highest horsepower production car in the world if you don't count like the Rebac Navara.
I think it's a weird choice to have behind her because it should be like our results were led by big trucks and SUVs. Look at this awesome Denali behind me and how well we're doing versus like this.
That's actually a great point. If she had had a Denali or an AT4, one of those high spec trims behind her, it would have made a lot of sense because that is where they make the majority of their money. But I think this Corvette, because it's such a standout halo vehicle like the Cadillac Celestiq will be, it just represents that GM is going further than they ever have before, really, in terms of, or at least in our lifetimes, in terms of the cars that it produces.
I have feelings on Corvettes, and they're not good.
Well, I think the Corvette is a very different vehicle than it has been over the past,
I still
6
feel
decades.
like it's like trying to compare like American luxury handbags. This is my reference point to like an Hermes. You can't do it.
Oh, come on.
It's not the same.
It's got an engine in the middle now, and it's, I mean, a phenomenal power plant. All right, we can talk more about this. Or you can tune into my podcast, Hot Pursuit, with Hannah Elliott. We talk all about this, and we debate the Corvette pretty much weekly. Tune in. Stay with us. This is Open Interest.
Less than 5 minutes ago until the start of your cash equity trading, looking at more gains. Can the Russell 2000 turn things around? That's the interesting one. It's fallen for 2 consecutive sessions, ending the outperformance that it saw for mostly all of the start of the year. At the moment, your S&P up 0.2%. The NASDAQ outperforms, Matt, up 0.5%.
All right, let's get a look at some of the single stock stories that we're watching for you this morning. UPS gave its first full year sales forecast in over a year. They had been holding back due to tariff uncertainty, and its outlook topped estimates nonetheless. The shares are not moving higher.
Decidedly not moving higher is JetBlue. It reported a wider than expected loss last quarter. It's targeting break-even operating margins for the upcoming year. Shares down 6%.
And software stocks like Cloudflare and Zoom are rebounding after weeks of losses over concerns about AI-related disruption. Less than 4 minutes to the opening bell. This is Bloomberg. Moments away from the start of trading on this. It's only Tuesday morning. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at gains for S&P futures, about 0.2%. We closed out at 69.50 last night, and 69.85 is the all-time high. So we're getting back closer to that level, and may hit it today by the time Romaine and Katie close stocks. We're looking at, well, gold.com. Ringing the opening bell. Every dog has its day, right? Actually, this stock is up 220% over the last 5 years. Only 30% this year to date. So if you look at the 5-year chart, it's like up, and then a huge drop and recovery. They're a happy bunch of people. Cullinan Therapeutics ringing the opening bell down at the NASDAQ, trying to cure cancer, and we wish them the best in that endeavor. However, the stock is down 68% over the past 5 years. I guess it costs a lot of money.
Yeah.
And investors are giving it away.
Yeah, I guess it's like a biotech company. They just need to have one good discovery and then have one big drug company buy them, and then things are okay. And the
right. Well, AI should help, right? Isn't AI?
Yeah, it helps with drug discovery. AI is very useful. I'm sticking with the healthcare theme, and I'm looking at health insurers at the opening bell. This is really painful. They are plunging. The U.S. announced plans to keep payments to private Medicare plans flat last year. Analysts were expecting a jump of up to 6%. So you can just see how much expectations were out of whack. You add to that, UnitedHealth forecast its first annual revenue drop in more than 3 decades. So that's down 15.5%. CVS down 9%, and Humana down almost 16% at the opening bell, Matt.
All right, General Motors expects profit to grow by as much as $2 billion to $15 billion this year. It also plans to give back a ton of money to shareholders, $6 billion in buybacks, a higher dividend as well. You can see the stock and the cash trade up 6% and change to $84. So General Motors seems to be profiting incredibly well off of what is reduced regulation, helping it to sell more of its big gas-powered vehicles and not getting hit as hard by the losses it takes on its broad EV offering. Let's bring in right now Miller Tabak Chief Market Strategist Matt Maley. And Matt, I want to ask you about GM specifically, but just it seems that this economy continues to do well. The consumer continues to hold in, and we're back to all-time highs on stocks and continue to hold at record tights on spreads. Does this all make sense to you?
Well, there's no question that the market acts really well. This rotation we've seen recently has certainly helped broaden out the market. That's very good. You mentioned 5,000 on the S&P or almost, and 50,000 on the Dow almost. It looks like we're going to pierce those levels. The one thing that does have me a little concerned, though, is what's going on in the credit markets. You mentioned that credit spreads are very, very tight. The one problem is that widening credit spreads are not a good leading indicator. They only widen out in any kind of meaningful way after things have already, gotten pretty serious. And we see what's going on in some of these global credit markets with this, doubling of long-term interest rates in Japan over the last 10 months. We see that, they've gone up in France, in the UK, and then, of course, in the US. It's only been for the last 3 months. But it's still 3 months is not, is not a short period of time. And they're pushing up against some key resistance levels. So at some point, I do worry that the credit market issue could create some problems. But right now, it's sure hard to fight the tape.
I wonder why we don't see credit spreads widening out already. I can't remember if it was Jimmy Carville or Bill Clinton. One of them wanted to come back as the bond market. Right back then, the bond market reacted when we spent way too much money and deficits and debt blew out and tamed the government, the administration, and Congress. Now, no such luck.
No, but and that's a concern. I mean, you see what's happening in Japan. I mean, they have a very serious credit crisis. Budget crisis right now, not a credit crisis, but it could be turned into a credit crisis. But the point is, their budget is really tough. And what is their new prime minister doing? Well, she's coming out with something that's going to cause a bigger, budget problem. So at some point, I guess my point is that I go all the way back to 1987. Now, I'm not looking for a crash, but I remember that time very well. I was on the trading desk at Salomon Brothers back then. And those interest rates rose for several months, and then nobody cared until they did. Now, again, I'm not looking for a crash, but I've seen that several other times in many different countries around the world. When interest rates go up quite a bit, at some point it does have an impact on the rest of the markets. And my point is that these budget deficits are something that people didn't really care that much about for most of the last 40, 50, 60 years. But now they are. Now they're demanding to get paid more for the risks that they're taking in buying the sovereign debt of some of these countries.
Matt, there's another market that I'm struggling with, and I hope you can help me with the record prices we continue to see in gold. Because the justifications, I'm going to be honest, are weird to me. On one hand, it's this idea that we're going to have a collapse in the currency. The dollar is just the lowest since 2022. That's by no means a collapse. Or there's the threat of inflation. But there's a market that gives us inflation expectations. It's in this bond market, and that's not showing up anywhere. Matt, is gold anything other than just a momentum trade right now?
I don't think so. I really don't. The one thing is that, Dani, when you see what's happening in these markets, again, interest rates in Japan have skyrocketed. The 10-year note has doubled in the last 10 months. Gold, silver, and other precious metals, palladium and platinum, they have skyrocketed. Why is that? And like you said, inflation is 3% in Japan or 3% here in the U.S., a little bit lower in Europe. That's not something that would cause these kind of moves. It's something else is going on, and I do believe, or I worry, that it's these budget deficits and that people are finally, for years, for decades. All anybody's cared about is the economy improving, what's going on with the economy, what's going on with inflation. That's going to determine the level of interest rates.
Matt, if I can jump in, why would that show up in the gold market and not the bond market? I guess that's the thing I'm struggling with. Why are these angst only showing up in gold?
Yeah, we can see that the long-term interest rates are rising, even though short-term interest rates are being cut by the Fed. Okay, and they're rising quite a bit in UK, who also has a budget deficit problem. They're rising in France, who also has a deficit problem. Germany, they're rising there for other reasons. But the point is that even though short-term interest rates are being cut, long-term interest rates are now pushing higher in the U.S. in a meaningful way, not skyrocketing to the way gold has, certainly, but they are moving, and they are pushing up a bunch, pushing above a trend line, making a higher high. These are the kind of things that signal on a technical basis that the trend for long-term interest rates is changing to the upside. So watch it. We're above 4.2%. If this continues over the near term, that we're going to get that confirmation.
You know, we just had the opening bell, and we booked you to talk about stocks, but we're all about credit, gold, and the dollar today. I want to ask you about the greenback because traders are paying record levels to bet on a continued drop, and we're already at a 4-year low. I was talking to a hedge fund manager this morning who said that this is basically the market voting on the administration's policies. Now, I countered that I think the administration wants a cheaper dollar, right? How do you view it?
Yeah, I mean, it's funny how, because everybody says, every administration talks about wanting to have the dollar strong, but every single one of them wants it to be lower because it, makes our products more attractive to overseas buyers. And so they like that. So I do agree with that situation. The one thing, though, I do have to point out, though, is that when you get so many people on one side of the boat, in this case, the dollar, and the DXY dollar index is testing a key support level. Whenever you test a support level and everybody's on one side of the boat, you usually get a decent sized bounce. So I wouldn't be surprised if we saw a bounce here on a near-term basis for the dollar. But longer term, this is, again, an important issue, and it says something about, what's going on in these credit markets. I mean, I don't know if you saw that. In fact, I read it on Bloomberg, the double line yesterday coming out saying that they're cutting back on their, this is investment grade debt purchases because of the froth in the market. So my point is that the stock market looks really, really good right now, but those credit markets are. There's some issues that we need to be careful about. So investors really need to stay nimble as we move through 2026.
Matt, we're going to have to end it there. Always a pleasure to have you on. Matt Maley of Miller Tabak. Thank you so much for joining us. 10 minutes into your trading day, let's get a check on where this equity market is right now. Breadth is pretty even, about the same number of stocks moving up as they are down. Actually, slightly more moving down, despite the fact the S&P 500 is up so far this morning. It's because big tech is doing well. Apple, we're going to get results from them on Thursday. Shares are up 2%. Microsoft, we get those results tomorrow. Shares are up 1.5%. Micron, chip stocks rallying this morning, up 3.7%. For this company, they just announced they're going to spend $24 billion in Singapore to spend on a chip building facility to try to address some of the glut. If you look at what's dropping this morning, you're going to see a lot of the health insurers there after the amount from the government paid to private Medicare plans remains flat for the year. Expectations have been for as much as 6%. Elevance Health, that's down 11%. Meta, Nvidia, Tesla, Netflix, some of the Mag 7 also having a rough go of it this morning. If you look at the sectors, healthcare obviously is going to be the worst. And it's, again, because of all those health insurers, by the way, also had bad earnings from UnitedHealth, too. So that only adds to the pain, down 1.1% for the sector. Financials down 1/3%. In infotech, it is higher. I pointed out that Apple and Micron and memory chip stocks were doing better. Energy is up 2.6% as oil prices move up more than 1% after President Trump said an armada was on its way to Iran. And he hopes he doesn't have to use it. That is an ominous message, but either way, equities are up 0.1% so far in the trade, Matt.
All right, we'll continue to follow all those storylines for you. Coming up, we're going to get back to American Airlines. It expects a strong year for air travel. We break down the outlook with analyst Tom Fitzgerald. This is Bloomberg Open Interest.
Let's get you some top calls. The analyst action that we're watching this morning. First up, Deutsche Bank, they upgrade Coreweave to a buy after NVIDIA increased its investment. Deutsche Bank says that the move reinforces confidence in Coreweave's fundamentals. Shares up 6.8%. Next up, Morgan Stanley downgrades Alcoa, saying that the recent earnings beat doesn't materially change the outlook. The firm says that it benefits from strong aluminum prices, but that is already fully reflected in the stock, leaving limited upside from here. Shares, though, are up 3.5%. 2.5%. Finally, RBC, they're out with a positive note on Cloudflare, arguing that growing AI adoption plays directly to the company's strength. They say that new AI tools and agents are driving demand for secure computing. Those shares, Matt, up 13%.
All right, big jump there. American Airlines, that stock is right now, over the last 2 days, I guess, down 4.5%, American Airlines. Even though it reported a strong forecast for the year. Let's bring in TD Cowen Airlines analyst Tom Fitzgerald. He has a buy rating on the stock with a $19 price target. Tom, let me pull up the American Airlines stock right now, currently trading off 4% at $13.97. Why do you think the market's reacting so poorly to this outlook?
Thanks for having me. It could be a confluence of factors. The stock's had a nice run over the last 3 to 6 months, so you could see some fast money accounts, profit taking, the impact of Winter Storm Fern, risk of another government shutdown on the horizon, and then I think some uncertainty and investor debate about the impact of the company's growth in Chicago this summer.
Tom, I mean, it's been a volatile ride just this morning for American. Earnings came out, stock plunges pre-market. Then it rallies. Everybody says the 2026 outlook is great or great given the circumstances. Then it falls again, given what you're saying. Is the 2026 outlook strong? American Airlines itself said that it was conservative. Should we not be expecting a pretty decent year for them?
I think it is a positive outlook. EPS was above our estimates, which were above consensus. They're expecting to hit their debt paydown targets a year early. I mean, we have a buy on it, so would view the weakness as an attractive entry point and a nice buying opportunity in the shares. So, I think it's just a volatile space and maybe more of a sell the news moment than a major red flag.
Our graphics genius, Joe, in the control room, threw up a screen of American versus United, Delta, and JetBlue. I guess America is outperforming JetBlue, but the other two big airlines are doing far better over the last 5 years. Is this a company that just has problems dealing with things like Storm Fern?
I mean, if you're looking at the last 5 years, I think that's a broader issue. I would say especially United got the bet right on international growth. They didn't retire any of their wide bodies during the pandemic, so that allowed them to ramp back up much faster and lean into the strong international outbound traffic out of the U.S., whereas American had retired a lot of their 767s and their A330s, which limited their ability to grow into the long-haul network over time. There was also the commercial strategy mishap about 2 years ago that cost them about 10 points of their corporate traffic share that they've recovered as they exited last year. But there were a few idiosyncratic headwinds in the recent history that's caused the underperformance versus United and Delta.
Tom, with this weather, with the cancellations we saw over the weekend, threat of maybe more cancellations to come with the bad weather, how much of these do we view as a one-off versus airlines needing to rethink strategies, maybe network complexity or fleet strategy? Does it have longer-term impacts than just momentary loss of revenue from grounding of flights?
It's a great question. I think the network complexity is a fair debate. And we saw United on their call talk about preferring 3 large-sized mid-con hubs versus 1 mega hub, of over 900 departures a day, due in part to the operational complexities that hubs of that scale bring. I think there's aspects of it that are just unavoidable. Weather's always going to create problems and challenges for airline operations. I would view this as more of a transitory issue that the market should look through versus any type of a year ago when we saw demand tapering off in the spring. That was much more of a check engine flashing warning sign type of moment for the industry.
Is the consumer, the higher end consumer, obviously still able to pay these prices and fly overseas? The lower end consumer has to struggle as 80% of the country is with prices of everything. Does that not bode poorly for American Airlines when they have to rely on the top 10, 20, or even 50% of the consumers?
Yeah, I think it's okay for the airlines. It's not the premium end. It's not just business class or lie flat seats. It could be anything from extra legroom economy seats. It's really just anything other than the back of the bus. So I don't think it's a super elitist definition. I also think there's reasons to be encouraged for the lower end of the market to come back this year, especially if we have a robust tax refund season that could serve to prime the pump a little bit for main cabin leisure demand.
Tom, what's going on with JetBlue? This is a company that said that it's been investing in premium. It's certainly building more airlines. We see that airline lounges. We see that in New York City airports. Why are they unable to turn things around at this point?
Well, I think a lot of their initiatives are going to need some more time to ramp and bear fruit. And I also think there was a perfect storm of issues that hit the company. Their merger with Spirit Airlines got blocked by the DOJ. They took a hit by the GTF engine groundings, which were out of their control. And then I just think the whole kind of industry construct flipped post-pandemic, where a lot of the secular tailwinds that had favored low-cost carriers turned into headwinds. So they've had to kind of be adapting to that. And they're doing. I would say they're doing everything. They're making all the right decisions and they're moving as quickly as they can. But I think just some of the things outside of their control dug them into a little bit of a hole. The leverage also is a cause for concern. I think that keeps some investors on the sidelines, where if there was a lower leverage point, you might see people buying in to support the stock more.
Shares down about 4.5% compared to Americans, drop of 4% this morning. Tom, thank you so much for joining us. TD Cowen Airlines analyst Tom Fitzgerald. Coming up, more earnings for you. UPS delivering a sales beat as it works to overhaul its network and reduce the amount of Amazon packages it handles. We'll break those results down for you next. Stay with us on Bloomberg TV.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check of what the stock market is doing now. Just about 23 minutes into the session, we're looking at 69.76 on the S&P 500, 69.85. Not that it matters, is the all-time high. So we're getting back up to that level. In NASDAQ at about 25,900 right now. I saw NVIDIA actually flash down for a moment. Now it's up 0.25%, but it's not really moving the market too much with these small moves. Coreweave, on the other hand, continues to gain this after yesterday's $2 billion investment and some upgrades, as Dani was pointing out, by analysts on that. UnitedHealth, with the rest of the sector, is down after it looks like Medicare spending will be flat. Boeing is off as well, even though it has a massive, almost $700 billion backlog. American Airlines is down, even though it had a 26 outlook that at least Tom Fitzgerald, the analyst we just spoke to, thought was positive. And UPS right now gaining 2.5%. This is a company that forecasts $90 billion in revenue. They just deliver stuff. They don't make it and sell it. They just bring it from one place to another.
And the business of delivery, I guess, is good. To your point, Matt, they beat Wall Street expectations with that $90 billion in sales. The profits also come with a big shift that they're undergoing. They've cut back on Amazon deliveries. They're overhauling its network. Bloomberg stocks reporter Matthew Griffin joins us now on the results. Matt, this is a company, this is what, its first full year outlook in a year. Is it fair to say that it's like the fog has lifted? We finally get an insight into how things look ahead.
Well, Dani, I would say the fog is lifting because, yes, we finally have another full year outlook from UPS. They had been a little bit more conservative in giving guidance as trade and tariff policy just shifted again and again last year. And the outlook that we got is being received positively by Wall Street. Yes, nearly $90 billion in revenue, Wall Street looking for about $88 billion. But there's a lot that is still hanging over this company. The impact of tariffs, the continued hit to revenue in some places from cutting business with Amazon. So we are still waiting, and analysts and investors are waiting to see how this all shakes out in the long run.
Yeah, I should point out, I mean, even though it blows me away, $90 billion, that's less than they've had in past years because they have such a big business with Amazon, although clearly it's a low margin business, not worth doing.
Yes, and investors are very aware of this. The stock fell 21% this year. It has a pretty, or last year, I mean, has a pretty deep hole to climb out of, down around 50% from its post-COVID highs. Investors have questioned this plan to cut business with Amazon, even though in the long run, Truist says there'll be a higher margin business.
Yeah, 21 and 22, they did about $100 billion. Matthew Griffin, thank you very much for joining us this morning. Coming up in the next hour, Paisley Nardini talks Mag 7 earnings. This is Bloomberg. We are 30 minutes into the trading day, looking at 69.76 on the S&P. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, just inches away from closing at another all-time high. But then the big day comes tomorrow. $7 trillion in market cap just coming from Microsoft, Meta, Tesla, ASML. So it'll be a big day. And you have the Fed. But before that, Matt, we have some economic data crossing.
Yeah, it looks like we're getting some breaking and disappointing economic news. Luckily, we have Michael McKee, our policy and economics correspondent, sitting next to me. So, Mike, what do you make of this consumer confidence number?
I'm your little black cloud correspondent. Well, it's a surprise because we saw a rise in the Michigan numbers, but the conference board numbers go down 84.5 from 89.1. The present situation seen at 113.7 compared to 116.8, and the expectations number is at 65.1 from 70.7. We're also getting here the revisions, so it's 84.5 on the headline number from 94.2, so an even bigger drop, which is unfortunate for those of you who are looking for consumers to lead the way going forward. Now, the question is, what is causing this drop? And I'm opening up the information here from the conference board, because the conference board numbers are much more closely tied to the jobs numbers, the job situation, than the Michigan numbers, which is more closely tied to the stock market. So let me look here quickly at the jobs numbers. The business conditions and employment numbers right now is a big drop in the number of people who think jobs are plentiful, down to 23.9%, and the number of people who think jobs are hard to get rises to 20.8%. So you can see that what's happening in the labor market is influencing consumers. The question is then, do they pull back on buying? I suppose one of the questions you want to know coming out of that is, what do people think of incomes? And they think their incomes are going to drop significantly from 18.8 to 15.7%. Those who think their incomes are going to go down think 71.7%. That's up from 68.2. So there's pessimism out there about the labor market and what that means for people, and overall buying conditions, just glancing at it, look like they're kind of down mostly across the board.
Thank you to our dark cloud correspondent, Michael McKee. Thank you very much for breaking down the numbers for us, those disappointing results from consumer confidence. Joining us now is Paisley Nardini, head of multi-asset solutions at Simplify Asset Management. Paisley, it continues to be a weird environment to operate in. Sure, consumer confidence is down, but people are spending. Earnings are coming in strong, but we're getting threats of geopolitical natures and otherwise. Inflation is still a concern. The FOMC meets today. In this very, very noisy environment, what is your North Star?
I was actually getting a little concerned. I felt like markets were kind of complacent. Everything felt good coming into 2026. So we knew there was going to be something beyond the surface, and you've just named many of those factors. This year, in my opinion, is a year of prudent participation. There's still a lot of catalysts for upside. I think markets broadly, despite some of that consumer confidence data that just came in, I think they're optimistic. I think they're seeing through the noise, and we've kind of seen that play out over the last couple quarters with a lot of geopolitical concerns, these earnings pullback. I think that's going to be a big catalyst over the next few days, especially as it relates to more of the tech-heavy market cap concentrated strategies that a lot of us have in our portfolios. So for me, really looking for ways to diversify. And I think, again,
that's key, I think, by the way. So I've been talking to a lot of people over the past few days who are more worried than they may let on publicly, because they don't want to be seen as a Pollyanna, and because, as Chuck Prince said, as long as the music's playing, dance, monkey. But
felt directed at me for some reason.
It's not directed at you. I think it's interesting. The confidence board number I'm looking at has now broken the COVID low. Mm-hmm. So it doesn't look that great, and I guess that's why gold is over 5,000, or was yesterday, right? People are scurrying to diversify, and it's like anywhere but bonds.
We've started to see that rotation play out. I think it started in the fourth quarter of last year, and it's picked up even this year. Obviously, as you point out, metals, gold. Now we're talking about silver, which they call the devil's metal, higher volatility profile. We've seen that whipsaw over the last 24, 48 hours. I think you're right, though. Investors are thinking about ways, how do I stay in the market? How do I ensure my clients are comfortable in the strategies that I'm allocating for them? in a way that they can sleep at night. That means diversifiers, that means real asset plays like infrastructure, like commodities, and also within equities, moving beyond that market cap concentrated space. Again, the earnings that we're about to find out over the next 48 hours could be quite strong to the upside. We could continue this trajectory of higher for longer as it relates to the technology sector, but what if that doesn't play out? And I think there's a lot of catalysts as to why a lot of this CapEx expenditure, is this going to deliver at the bottom line for these tech companies?
I think in the first 3 weeks of the year, there was a lot of hope that the broadening out would also take the form of small caps. It outperformed the S&P. That ended not just yesterday, but the day before too. But it is still an index composed of a lot of unprofitable companies. Paisley, what needs to change to actually allow sustained outperformance from these smaller companies?
Small caps have been interesting. There's these episodic plays over the last couple of years, right? Small caps will rally meaningfully for a couple weeks and then it runs out of steam. I don't see that changing anytime soon. I think further catalysts for small caps to continue are going to be the trickle down of AI, but that is a longer term narrative. In the short term, the catalyst for small caps to continue to rally alongside large caps is going to be rate cuts. And so that really, as the Fed is going to wrap up their meeting tomorrow, I think markets and the Fed are unlikely to experience any cutting in this meeting. But ultimately, a lot of these risks that are at play, from geopolitical risks, the new Fed chair, thinking about just broadly some of the movements in the back end of the yield curve, does this translate down, especially through economic data, to result in rate cuts, which could be that catalyst for small caps?
By the way, I'm looking at WIRP on the Bloomberg terminal, the world interest rate probability function, and the terminal rate's not down as low as it had been. It was below 3, and now we're looking at, I think the lowest I see, at least on this screen, is 3.15.
Yep.
So I guess expectations for rate cuts aren't as strong as they once were.
And that we continue to see that move around, and I think investors should expect to see that move around quite a bit over the next few months. I think a lot of the narrative too is less so about, is the final rate 2 3/4? Is it 3? Is it 3 1/4? I think those are all in the same ballpark. Bigger picture, the trajectory is for rates to fall a little bit from here. And so,
well, how important, Paisley, is the Fed choice? I mean, if President Trump picks Rick Rieder, does that change your strategy compared to if he picks a Kevin? I mean, specifically.
Right now, it sounds like Rick Rieder is in the top slot to get selected. Ultimately, any of the selections that the administration is going to choose are going to be pro-rate cuts. There's a political bias behind this. And so I think we're headed in that direction. I think the speed at which we get there is what's TBD.
What about international stocks? You have a trade agreement between the EU and India that will take some time to actually see results from, but it's a step in the right direction. Mark Carney is calling for middling countries to come together. There is this real sense that it's not necessarily the end of globalism, but it's a pivot away from the big world powers of China and the U.S. Does that change your outlook of where the engines of growth globally come from?
2025 was a prime example of international stocks coming into play. And I think that was really important to put back on the radar of so many asset allocators here in the U.S. is this concentrated home bias. I think further tailwinds to international is really going to be a story of the dollar. I think any depreciation in the dollar might be that catalyst for international stocks to play out. Ultimately, the geopolitical risks that we're seeing in Europe, obviously with China as well, we'll see how those play out, but ultimately I think this could be a really strong year for diversification, not only potentially in small caps if we get those rate cuts, but depreciation in the dollar could be tailwinds for international.
I think it's a really important message, Paisley. I'm glad you could come in and share with us today. Paisley Nardini there, Simplify Asset Management. Let's get a check out what's going on in the markets right now. 38 minutes into the session, we're looking at 69.73 on the S&P, a gain of 1/3 of 1%. The NASDAQ putting up an even stronger gain, 0.8% to 25,917, so that's accelerating throughout the morning. You see the dollar index continue to fall, and we did hit a 4-year low on the Bloomberg dollar index, which is a broader measure of the greenback than, say, just the DXY alone. I think
Yes.
a better measure.
I would probably agree with you on that front, Matt.
You should.
I do. All right, some of the single stocks that are moving this hour. Health insurance companies, they're taking a hit. The U.S. announced plans to keep payments to private Medicare plans flat next year. UnitedHealth also forecasting its first annual revenue drop in more than 3 decades. Shares slammed as much down as 20%.
Yeah, getting absolutely decimated and then some. General Motors going the other way. It says profit will grow as much as $2 billion this year. It plans to give $6 billion back to shareholders and boost its dividend. As a result, the shares are up almost 7% now to $84.79.
And some breaking news crossing moments ago. Amazon is closing its Amazon Go and Amazon Fresh stores, signaling a major shift in strategy. The tech giant is going to refocus on higher growth businesses while planning over 100 new Whole Foods locations nationwide. Joining us now for more insight is Bloomberg Tech co-host Ed Ludlow in San Francisco. Ed, why the change in strategy?
Yeah, closing and shuttering what was already a diminishing footprint, right? There are only 14 Go stores. We have one of them, or had one of them here in SF, and 58 Amazon Fresh stores. And as you point out, that real estate gets converted to Whole Foods. This is not Amazon saying that they are done with grocery. Far from it. It was interesting when those headlines hit. Clearly, there's an algo reaction, right? And Amazon pared some of its gain. It's now back up to a 0.6% gain. But Walmart took a leg lower, because the commitment from Amazon is very much to grocery in the context of same day, right? They've been focused very much on the online offering and doing those hourly deliveries and slots, but foot traffic's been falling away on these early locations. I don't know if you guys have ever been into an Amazon Go, but it's the humanless facility where linked to your Prime account, you just kind of pick up the items and leave, and it detects it and charges. But they found scaling that tech very difficult. So that's the rebalancing of what was already a small footprint. Do away with those physical stores, commit more to Whole Foods by opening new branches, and then double down on getting groceries delivered through online mechanisms as quickly as possible.
Yeah, I had never been. I mean, there's only 14 stores. It's not unheard of that people have never been to one. I haven't, although Dani, oddly,
yeah, I went in London.
Has been to one. I do that kind of shopping at ShopRite, but I guess Whole Foods is just as well. Where are you seeing this? Where are you seeing reaction across markets, Ed? What are you hearing?
Yeah, again, I always load up the ticker. So when the news hits, Amazon did something a bit squidgy, could be algo related, but the Walmart move is kind of interesting. There's never been this looking over the shoulder from big box retail that Amazon is going to sort of dominate the physical store world. The opposite, Walmart wants to take a greater share of the online battle. It has its own subscription offering. It is committed to rapid delivery, as is Target, as another example. And, bringing Walmart now down 1.2%. But in that moment that the Amazon posted its blogs and we sent the headline to the terminal, that was the biggest move that I saw. One thing on Amazon, though, right? The vast majority of operating income is AWS and cloud computing. And this is the thing that's hard to understand with the many-tentacled beast that is Amazon.
Isn't there a degree, though, Ed Lowe, and we're about to get into the earnings season with all these Mag 7s, that all of these are just diversification for Amazon? It's not a company that's dependent on one thing. And isn't that just such a benefit right now when we're all worried about this beast of circular financing coming from the likes of NVIDIA and OpenAI?
Well, AWS cloud computing is the majority of our operating income, but Amazon.com and its many branches is still the great driver of revenue. And within Amazon's earnings, there are always surprises to the upside. Advertising and the integration of more advertising within the e-commerce part of the business has been a great boost for it. Showing Target right now being down 4%, I think that was a name that was pretty much under pressure anyway before those headlines hit. But Amazon is also sort of continuing to think about the whole suite of consumer in-your-face stuff, video, healthcare, and basically bundling it up in an ecosystem it calls Amazon Prime, just like Apple tries to have an ecosystem of devices and software too.
All right, Ed, look forward to your coverage. Bloomberg Tech kicking off in 46 minutes time. Ed Ludlow will be co-anchoring that show with Caroline. Coming up, Apollo taking a loss on a zeroed out asset-backed loan in a rare stumble for a strategy considered fairly safe. Our credit segment is next. This is Bloomberg Open Interest. Let's get into high interest and look at what's making headlines around the world. Yale University says it will offer free tuition to undergraduates from families that earn less than $200,000 a year. Starting with the 26-27 academic year, families making under $100,000 will pay nothing at all. Isn't that the same as free? I don't know that I follow 100%. But Yale says the move means more than 80% of U.S. households could qualify for tuition-free aid, matching similar steps by Harvard, Princeton, and MIT as college costs climb past $90,000 a year. DoubleLine Capital is dialing back corporate debt buying, warning that credit markets look dangerously complacent. This is what Matt Maley was just telling us about. Risk premiums are near 30-year lows just as companies gear up for record borrowing tied to AI. The firm says this is a risk-building year that requires a move up in quality, less junk exposure, and more treasuries. And CVC Capital Partners inked a deal to buy Marathon Asset Management for $1.2 billion. That has resulted in a windfall for Blackstone. Blackstone's GP stakes platform, which held minority stake in Marathon, made over 3 times its initial investment from the deal, a gain of over $400 million. The deal highlights booming demand for minority stakes in investment firms as private capital matures. Dani?
Just one thing on the Yale thing.
Yeah.
I think the deal is if you make less than $200,000 free tuition, below $100,000, like everything is free. So like housing, food,
beer,
etc. Totally. I'm sure they're giving away free beer. Anyway, you are looking at a screen, let's talk about it, of Apollo. Apollo seeing a rare setback, taking a loss on a portion of $170 million asset-backed financing for an Amazon brand aggregator Perch that was written off to zero. That loss represents about $500 million commitment. Joining us now is Bloomberg senior reporter Silas Brown. Silas, ultimately, these are the kind of figures that I guess are like a drop in the bucket for Apollo. So what's more important, the loss itself or the fact it was a loss for ABF, something that has been billed as very safe?
Yeah, I think it's the latter. I mean, I think the way that I see this story is that it's a kind of shot across the bows for an area of private credit that was seen as the kind of great, sort of success story and this kind of like great kind of area of scale for the market, and crucially a way for insurance companies to put their balance sheet to work in the industry. And I think this is a kind of rare blemish and somewhat of an interesting phenomena because the way that asset-backed credit is structured normally really mitigates against the risk of loss. So as you say, I think it's a kind of important, it's an important sign.
Well, can we just talk about the structure of this itself? Wasn't it highly complicated and structured in exactly the way that you're talking about, Silas? How does it record such a loss when it is built in a way to try to mitigate these risks?
Yeah, I was dreading the question of how it was structured because it's very immensely complicated. But I think the essential point is that the way that these kind of transactions work is they're intended to be like substantially less risky than the, I guess, like direct exposure to inverted commas private credit. And so how they do that is keep the investment somewhat, one step removed from the actual loan, the actual exposure, by structuring it to make it kind of more senior to the underlying lending. And I mean, that is an enormously successful trade. And I think a lot of insurers' balance sheets are kind of being funneled into these types of investments. But as I say, I mean, it's kind of a fallible thing. And as this story demonstrates, it's a kind of warning shot for the industry.
Silas, I want to ask about the CVC deal for Marathon Asset Management because it struck me as a low price considering the assets under management at Marathon, well over $20 billion, and the price tag of $1.2 billion, with a third of it apparently going to Blackstone investors, seems like a real discount. Why?
That's so interesting that you say that because, by the way, I should caveat this point by saying I am by no means in any way an M&A analyst. But what I would say is it's interesting you say that because I've had actually people saying it was kind of overvalued and people saying it was undervalued, and then some people saying that it was kind of just about right, which I suppose is kind of the nature of things. I would say, look, I mean, I think Marathon has been fortunate in that they've kind of found themselves in this position of strength as a somewhat independent. I mean, I know that Blackstone had a stake, kind of arguably a global manager, definitely strong penetration in the US to these kind of like buzzy forms of leverage credit. And so yeah, I mean, in this kind of quest of the larger private capital managers to kind of scale and develop these multi-product offering machines, like Blackstone and Apollo, but also CVC. Notably, I thought Marathon and Bruce Richards and and the kind of team there have been beneficiaries of that trajectory.
Hey, Silas, thank you so much for this morning and all of your reporting. That's Bloomberg's Silas Brown. Still ahead on the show, hedge funds are back. Returns and inflows are their strongest in a year. And later this hour, we're going to speak with Ilana Weinstein of the IDW Group on what's driving the comeback. That conversation coming up. This is Bloomberg Open Interest.
Get a check on the stock market right now. Looks like we're making some stronger gains, more solid gains, although breadth is actually to the downside, just slightly. 239 stocks down, 239 up, 261 down. So breadth is just a bit to the downside. Right now we're up about 1/3 of 1% at 69.72. I thought it looked a little more solid because Nvidia is now gaining about 1.25%, and it had been flipping down for a little while. Apple and Microsoft and Amazon, as well as Google, are also all on the upside. On the downside, Berkshire Hathaway is off a little more than 1%. Elevance, as you've been pointing out, Dani, getting decimated today, and then Walmart coming down, maybe because Whole Foods will be a better competitor now that it can occupy Amazon Go's 14 stores.
That's like the future that is promised of a merger between like Apple and Amazon and Microsoft. I could definitely see that coming. Okay, coming up, we're going to speak to the CEO of a French environmental services company, Veolia, on opportunities in the U.S., especially as AI guzzles up all of the utilities of water, of energy here in America and abroad. That conversation coming up next on Bloomberg Open Interest.
French environmental services company Veolia is making a new push into the U.S. The company agreeing to buy Enviri's hazardous waste unit for $3 billion at the end of last year, doubling its footprint in the U.S. sector. Joining us now is the CEO of Veolia, Estelle Brachlianoff. Estelle, great to get you on the program. Thanks for coming on. I wonder if this is the right time for the growth of an environmental services business in the U.S. You would think that under this administration, we would have far less regulation and thus less need for an environmental waste cleanup service.
No, it's a great question. And actually, you're right. Veolia is a global leader, 50 billion turnover worldwide of environmental services. And we're investing massively in the U.S., already a 6 billion business in the U.S., and investing massively and growing super fast because the demand is here. Whatever the ESG agenda at a central level is, you have a great, very strong demand from industries and communities in these countries. We're talking here about ensuring essential services such as drinking water at the tap in a secure and affordable way. We're talking here about ensuring and securing supply chains because, AI, data centers, microelectronics, or pharma, they all absolutely need our service just as a license to operate, to treat pollutants or to ensure that you have a supply of water sustainable throughout the year.
Estelle, I mean, we talk often about energy being this battle between everyday people looking for affordability to power their homes and the demand coming from AI. That conversation has been basically non-existent when it comes to water. Is there a real tension between AI demands of water and everyday people's use of water?
I guess the conversation is starting to happen on water demand from AI and data center in this country. We have at Veolia some solution and some offer to make data centers more sustainable, meaning recycle water, because you need water to cool down the data center, as well as, treat the electronic waste which you have within it, or use the wasted heat which is produced by data centers. So yes, we have an offer. And on the on the balance, we as well use AI to make our company more efficient and therefore our services more affordable. We use AI to ensure that we consume less energy, less water, to distribute drinking water at the tap of Americans.
We're so focused on AI here every day, on the data center build out as well. But I wonder about the reshoring of U.S. manufacturing, as that is a top priority for this administration as well. And your business benefits from reshoring. What are you actually seeing here in the U.S. in terms of that manufacturing movement, and how are you helping?
So you've mentioned in your introduction that we've made a big move of acquiring the signing of the acquisition of Clean Earth a little bit earlier, a few weeks ago.
Clean Earth, yep.
This is a massive investment for us to ensure that we double the size of our hazardous waste business, which is treating pollutants specifically for strategic industries. So what we see in the US is that strategic industries, so microelectronics, pharmaceutical companies, for instance, or even mining, they all need those type of services. So there is a high demand, and this is a rising demand. And it's a license to operate for them. So do we see already a big investment in those sectors? Yes, we do. And the notion of strategic industries is something which, in the geopolitical tense world as we see it today, is becoming absolutely paramount. And they need the services that Veolia can offer.
Again, going back to what you're talking about and where we started of cleaning up hazardous waste, it has been a real rising concerns, the existence of PFAS. More research comes out about just how much it exists in fish, in our own bodies, potential harms from that. Estelle, have we really grappled with how big of an issue this is? Are we moving fast enough to address the existence of forever chemicals and forever plastics?
I guess this is where I think, the model of Veolia, which is a global company having the scale to invest massively in innovation and technologies, as well as the locally embedded in the communities like in the US. PFAS is a perfect example of that. We have already a very comprehensive offer to be able to treat PFAS in the various different type of PFAS we have. And we've developed that through our innovation and water technologies, which is really unique in the world. And we already see a lot of demand for those services in the US. So it's happening here and now. Of course, it can happen quicker, but actually there is already a big push. And I think this is, I'm very optimistic about the way going forward, because we're talking here about a real bipartisan issue, which is to ensure we protect health. And health is something which is really driving a lot of what we do in terms of decontamination, health protection.
Hey, Estelle, you mentioned obviously Clean Earth, and we talked about the unit from Enviri that you're buying, or Enviri. You've been fairly acquisitive lately, and I'm wondering if there are still holes in your portfolio that you're looking to fill.
Actually, the priorities for Veolia is very clear. The company is transformed its portfolio and still is transforming its portfolio towards very international and very much more tech-driven and fast-growing type of businesses, which means, you're right, we are investing massively in hazardous waste, and we've invested earlier last year in terms of water technologies as well. And we won't stop here to transform the portfolio of Veolia because, again, the drivers, so be it in terms of decontamination and health protection or ensuring the secure supply of water, are something which we see a high demand in the US and elsewhere in the world.
Estelle, thank you so much for joining us this morning. Great to catch you as you're over here in the US. Veolia CEO Estelle Brachlianoff. Let's get a check on markets this morning, because we're about just over an hour into your trading day. Despite the fact we consumer confidence hitting the lowest level since 2014, equities are unfazed. Stocks, especially the NASDAQ, rallying this morning ahead of Mag 7 earnings. We got 4 of them coming out tomorrow. Maybe the one market reacting is the 10-year yield, or the front end of the curve, rather. The 2-year yield, that is lower by about 2 basis points after that data came off. Bloomberg dollar spot continues to trade around its 2022 lows, Matt.
All right, we will be watching, obviously, those markets very closely as the Fed meets. The Fed's meeting now, and we'll give a decision tomorrow. Let's get a look at some of the single stocks moving at this hour. Amazon says it will close its Amazon Fresh and Amazon Go stores. If you were lucky enough to see one of those near you. They were pretty rare, but they are going to expand same-day grocery delivery options and put Whole Foods in those former Go and Fresh locations. It's having ripple effects across the grocery universe.
And UPS, I like grocery universe.
Oh,
That's very exciting. UPS shares, they're up 2.5%. The shipping giant beat Wall Street expectations, forecasting nearly $90 billion in sales. But the profits will come with a shift. Speaking of Amazon, they are cutting back on Amazon deliveries and overhauling its network.
Boeing results fail to impress. Despite the plane maker reporting a second straight quarter of positive cash flow and a almost $700 billion backlog, the shares are down 2.33%.
Coming up, hedge funds making a major comeback. We're going to speak with Weinstein, CEO of the IDW Group, about what's fueling the resurgence. That's coming up next. Stay with us. This is Bloomberg. $2025 proved to be a strong year for the hedge fund. Performance across funds was the best it's been in over a decade. And a recent Goldman Sachs survey showed that hedge funds are now the most favorite asset class among institutions. But even as optimism returns to the industry, Goldman CEO is striking a cautious tone, at least for his bank, on hiring this year.
It's probably a little bit more constrained in 26 because we see opportunities for efficiency and we're trying to deploy those. But ultimately, we've also said those efficiency opportunities give us more of an opportunity to invest in parts of our business where we can scale growth. And some of that growth scales with additional headcount. I'd point to our wealth management business, which scales with people all over the world.
I'm pleased to say joining Matt and me this morning is Weinstein, CEO of the IDW Group, a top executive search firm for the hedge fund industry. Alana, thank you so much for joining us, this industry. And of course, we can say, obviously, Goldman Sachs business is not a hedge fund. But if there are advancements being made
Did he just say talent slowdown?
Yes,
was
talent,
that
exactly.
Okay.
And I just wonder if a bank can find efficiencies and if they can find ways to make workers more productive. Can hedge funds do the same too? Are technologies allowing them also to slow down on their acquisition of talent?
So that's a really interesting intro to this segment because for all of the headlines of hedge funds have had a banner year, they've put up great performance, which we can dig into because I think these averages obfuscate what's actually going on. The real headline for hedge funds is not inflows and capital. We have $5 trillion of AUM. This industry has a tremendous amount of capital. It doesn't have a capital problem. It has a talent problem. That's the problem. All of these funds, and by the way, when I say all of these funds, the majority of inflows since 2022 have gone to the multi-managers, which are the most voracious acquisitors of talent. When you talk about efficiencies, yes, you can make certain aspects of the fund more efficient, but you can't there's no replacing the talent that is deploying the capital. And these are paradigms with multiple PMs, multiple teams. And the reason some of them are actually giving back capital or being really discriminate about how much they take in is because there has never been a bigger supply-demand imbalance with respect to talent. The talent war is as intense as it's ever been. So it kind of makes me laugh a little bit to see the other side of the equation, which is like we're having a slowdown with respect to talent growth.
By the way, you have arguably the deepest look at hedge fund performance because you're seeing it on an individual manager basis, but also across funds. The headlines that we've been reporting about 2025 have been really phenomenal. Best returns in 16 years, gathering the most in terms of inflows since 2007. Is it not?
Right.
Are we wrong to paint hedge funds with such a broad brush?
I think it's almost kind of like, the average car in America went up by X percent. Like, what is it actually telling you in terms of the price? What we do, we're like surgeons, Matt. We go in and we do the same thing LPs are doing, and we ask the same questions, which is how much of the performance is alpha net of fees relative to the underlying beta. We're looking at performance relative to the volatility employed. We're looking over a 3-year and a 5-year basis. One banner year, does not an industry or a fund make. And at the end of the day, when you look at all of this, and let's not forget too, a whole segment of the industry had a huge tailwind. That's the long short world, right? We had a stock market boom. Kind of everything worked this year. Right. All the, the stage was set for funds across all strategies to have a good year. Like this is, I would say the differentiation is if you didn't, shame on you. There are very few funds that are that exceptional. They're out there, but they're few and far between. And that is why you see so few funds hoovering up the capital in this industry. 10 years ago, and I bet you the percentage hasn't changed much, 10% of funds controlled 90% of AUM. Now, some funds have gone out of business, some are closed, maybe the percentage is slightly better, but thematically it remains the same. There are very few funds that really are giving LPs value for the fees that they're paying.
Without those details, if you were to just look at the headline level, another conclusion you would have made is, wow, this must be a great time to launch a fund. Everybody's doing well, there's lots of demand. But given what you're saying, that there is wide dispersion, yes, we had a few big splashy launches like Bobby Jane's fund. Is it a good time to be starting your own fund?
Okay, so there are two ways I can answer that question. Let me start with the Bobby Jane comment. You guys did an article a couple of weeks ago about the fact that the gross return of that fund was mid-teens and the net return was a quarter of that. So I think I'll get to your question on launches, but there's an important point here, which is you want to be really thoughtful if you do launch at the scale with which you launch, especially a multi-manager, because you have to deploy all of that capital and you have to hire multiple PMs to do it. And they have a lag with respect to showing up, right? They have non-competes, the team has non-competes. You're also spending on R&D, on technology, on ops. And so it takes a while for the machine to prove it's working. That's on scale. On launches, you're right. There have been very few single manager launches of note that are north of $1 billion. There is NX1, Harvey Capital, Aventir. That's really off the cuff, what I can think of as the notable launches. Every single one of those was started not just by a senior investment professional, but somebody who was co-PM or co-CIO managing the fund. So there's a footprint there, which is very unusual, and I think LPs were able to get behind that. But otherwise, it's really tough, which is why you're seeing the number of SMAs that we're seeing with respect to new funds starting. And this goes back to the talent issue. If it's hard for multi-managers to access talent to keep pace with the amount of capital that they have to deploy, Millennium being probably the most extreme example of that at $84 billion, and also the most prolific allocator to new launches in 2024. They gave more money to the industry. Remember, they're a hedge fund themselves. They're allocating externally than those that are supposed to allocate, than institutional LPs. And this past year, they were behind 4 of the 9 biggest launches. But those situations often come with strings attached, right? It's the only LP for a period of time. It's 3 years before you can take in other capital. There's transparency that potentially the allocator has into your book, which if it's a hedge fund could be a problem.
Ilana, can I just ask quickly, what does this mean for managers that want to move right now? Or if I look at Marathon, and I know they're not a hedge fund, they're an asset management company, but if they want to leave some of those women and men, is it a good market for that?
I mean, if they're talented, absolutely. We're all over talent every day of the week. And there's a knife fight for anyone who's talented. So is there a good market for talent? That's what I mean by supply-demand imbalance. Talent is holding all the cards. And the challenge for top hedge funds is to figure out how they're going to differentiate themselves so that, and I say top hedge funds because if you're a second-tier fund, you don't have a prayer of attracting the best people out there because they have incredible options. The challenge is figuring out how you're going to differentiate yourself. A check is not enough. Like back to those SMAs, just writing somebody a check, we have a while before those SMAs prove themselves out. This is a relatively new phenomenon born of the incredible growth that the multi-managers had over the last, let's call it 3 years. We'll see how well those funds do. But then you look at a fund like ILEX, right? That is an example of a hedge fund, Woodline, giving a strategic investment to a startup, but doing a lot more than just writing a check.
Alana, this has been so interesting. We are just up against a break, but you have to come back. This has been so fascinating.
Anytime.
Thank you so much, Alana Weinstein, CEO of the IDW Group. Coming up, President Trump heads to Iowa to push his economic agenda. Tensions simmer in Minnesota. We're going to get the latest update from Washington, D.C. next. This is Bloomberg.
President Trump is heading to Iowa today to meet state lawmakers and deliver a speech on the economy. But Minnesota is still front and center for many Americans following the killing of 2 U.S. citizens by masked federal agents. U.S. Border Patrol Commander Greg Bovino is now said to be leaving Minneapolis amid the backlash there. Bloomberg Washington correspondent Tyler Kendall joins us now. And, this administration is very good at changing the news cycle and bringing up something new when there's too much attention focused on something it doesn't want to. How are they dealing with Minnesota? Is sending Tom Homan really going to quell concerns about, what looks like a murder of 2 American citizens?
Well, Matt, you do bring up a very big question that we are grappling with at the moment, because while sending the border czar Tom Homan into Minneapolis is considered to be a bid to de-escalate tensions, he, of course, is a staunch supporter of President Trump's broader deportation policies. But this is considered to be a shift in strategy from the White House, as President Trump indicates he is willing to make some changes when it comes to the response happening in the city there, most notably, of course, pulling out the U.S. border chief. But I'll also bring up that he did speak by phone yesterday with the Minnesota governor as well as the Minneapolis mayor, and he indicated that they were, quote, very good calls in his words, and suggested that they're going to keep those lines of communication open, appearing to try to quell concerns that there has been a lack of coordination between federal, state, and local officials. I'll also mention that the White House did suggest yesterday for the first time that we could see a pullback in ICE agents in Minneapolis if there is what they're calling a, quote, cooperative measure taken between local and state officials to help the federal government with their immigration enforcement. So perhaps some more things on the table there. But this bid at de-escalation comes amid mounting pressure and criticism of the administration's initial response, which has appeared to undercut what we know officials want to focus on, which is that of the economy with this speech today in Iowa. So we'll have to see if this could potentially be a reset for President Trump in a bid to try to get more of this focus, renewed focus on those cost of living issues, since we know this is something that Matt and Dani, the administration, has wanted to see for weeks, but has repeatedly been undercut. Take last week in Davos, for example. It was our understanding that that speech was going to be focused solely on affordability, but it got overshadowed by Greenland.
Tyler, thank you very much. We'll see what that speech in Iowa brings. Bloomberg's Tyler Kendall. Let's get a check on your markets about an hour and a half into your trading day. Will we hit another record? I believe. Is that a new record, Matt? What is the new record?
No,
it is not.
69.85.
There you go.
The closing level, right? And the intraday level is higher.
Exactly. So we're not there yet. We were about 0.5% away, so we're close for what it's worth. The NASDAQ that outperforms ahead of a lot of Mag 7 earnings. Matt?
Coming up tomorrow, Scott Cronert of Citi joins us, as well as Abby Joseph Cohen of the Columbia Business School, ahead of a Fed rate decision, plus the CEO of Logitech following the company's earnings report. This is Open Interest.